Good morning, everyone. My name is Chris Lopez, and I'm a real estate agent here in Denver at YourCast Real Estate. I focused on helping people buy investment properties. And a part of what we're doing on today's episode is a continuation of our tax series. So the previous episode was titled Tax 101, and that's really the introduction to taxation and real estate investing. So if you're listening to this or watching this, have not heard that previous one, I'd recommend you start there, then move to 201. And this is going to be on advanced strategies for real estate investing. And then the third episode will be 301, which are some exit strategies. But I myself am not a tax expert, but I like learning about it because it's definitely important to know. But my guest is an expert. His name is Peter McFarland, and he is a lawyer and CPA at the Business Innovation Group here in Denver. Good morning, Peter. Thanks for coming back.
Good morning, Chris. How are you?
I am doing great. So, advanced tax strategies. What is that? I don't know where to start. How don't you dive into this?
Yeah, absolutely. I mean, today what we're really looking at are really powerful ways for you to save money and not pay any more over to the IRS than you really need to, and geared specifically at real estate investing. What I'm going to try to do is do my best to maybe target these strategies and explain kind of who I'm envisioning would use these strategies. But Chris, maybe you can keep me honest, and as I'm going, if I'm not doing a good job of that, then just have me kind of walk it back a little bit and say, okay, yeah, actually this works really well for, say, a landlord or a fix and flipper or something like that. So
sounds good.
Great. Well, at any rate, thank you for joining us. Today I'm here with Business Innovation Group, a new venture, sister company to Long Law Group, LLC, which Long Law Group, the law firm, has been around a lot longer. You may be a little bit more familiar with them and that brand. But at any rate, they are sister companies. But this is a picture of me. Can't help but give myself a little bit of love here. And I am on LinkedIn. Of course, welcome everybody to connect with me if you have the opportunity. Business Innovation Group, just a little bit about what we are. We are business advisory and planning, a business advisory and planning firm. What we do is we really pride ourselves on the ability to do some revenue and profit improvement, cash flow analysis. We can actually forecast out into the future, run what-if scenarios based on your numbers, and see if we can come up with any insights to help you decide if it's time to expand or what would happen if certain good or bad what-if scenarios were to occur. We do tax planning, tax preparation, bookkeeping. We set up business entities and advise kind of on their life cycles. So keeping them in compliance over the years, shutting them down, merging them, whatever it may be. We do executive development, and specifically, and really pertinent for the listeners of this webinar, is real estate strategy and planning. This is a picture of my team. The strength of Business Innovation Group really comes from the team. No one person really is the end all be all, although I like to think that oftentimes I am. But really, any good solution is going to pull from the strengths, right, of your team. And so just wanted to give you a sense of who's kind of standing behind me as well, right? So with that opening perspective, I want to just take a second. Normally, I have like several slides and I kind of get up on my soapbox a little bit. Today, it's actually really fast. Just one slide. Hey, in and out kind of thing. But look, last time, actually, if you had the opportunity to join us for Tax 101, we actually looked at some trends coming out of the Tax Cuts and Jobs Act and who it really targeted, who's benefiting the most from the changes that we're seeing out of that act. And I think if you pair kind of the analysis that we looked at last time, as well as look at general trends that have happened kind of over the last 10, 15, even 20 years, you'll find that increasing tax burdens are actually the reality for most of us Americans. The thing is that things are just getting more expensive, right? And that includes the services that we kind of rely on the government to provide. And so things are just getting more expensive, right? And so our relative tax burden, unfortunately, is increasing. So trends and data show that this is true over time. So today, what I'm talking about, my aim, my objective, is to teach you strategies that are going to allow you to just pay your fair share, right? And so we kind of talked about this last time, Chris, but do you remember what the difference is between tax evasion and tax avoidance?
not going to jail? Actually, don't.
You're exactly right. It's a really bad tax lawyer joke or CPA joke, but it's, look, 10 to 20 years is the difference, right? And what we're talking about today is tax avoidance, right? Tax avoidance is legal. That's what I make my living doing. Tax evasion, on the other hand, that's illegal, right? And that's what's going to land you in jail. So today, what we're talking about is tax avoidance. At the end of the day, what I'm really trying to get you to think about and really kind of begin to frame the picture around is that we're going to do our patriotic duty, right? We're going to pay our taxes, but at the same time, we're not looking to give any gifts to the IRS. And if you are preparing your taxes in a way that's disadvantaged to you, in the sense that you're not taking advantage of all of the different provisions that the tax code has that potentially is going to benefit you, that's really what you're doing. You're giving gifts to the IRS. The thing is that the IRS is never going to come to your door 3 years from now and say, if you had made this particular election, or if you had taken this particular position, you would have owed $5,000 less in tax. So here's your $5,000, right? That's never going to happen. Those are just straight up gifts to the IRS. So we're going to pay what we need to pay under the law, but we're not going to pay a single penny more, right? So without further ado, I'm just going to jump into the very first thing I want to talk about today, which is self-employment tax. So this actually dovetails quite nicely into some of the topics that we brought up in Tax 101. When we're talking about self-employment tax, just kind of thinking generally, if I list out these different types of real estate investing or real estate activities, okay, if we have brokerage income, wholesaling, if you're a contractor, if you're engaged in rehabs, you're fixing and flipping, or maybe you're improving and selling raw land. I mean, besides real estate itself, besides the actual, land, what do these things have in common?
Well, you have to actively work to produce income at these. That's what I would say.
Exactly right? The only strategy that's up there, or that's not up there really, is rentals, right? And that's because those rentals are more associated with that passive income. So that's exactly right. I mean, a way to think about it too is with these things, you're kind of your own boss, right? You might be like a subcontractor or a real estate agent, but to some extent, you're setting your own hours. You're kind of deciding what ways that you're going to go about meeting the goals that are in front of you. So you're your own boss is kind of another way to think about it. So specifically with self-employment tax, I mean, it's kind of a circular loop, but it's like, who pays self-employment tax? Well, the definition that the IRS gives you is, well, those who are self-employed. Well, it's really helpful, right?
That's a great definition.
Yeah, I know, right? But, the IRS considers the following individuals to be self-employed. You're going to carry on a trade or business as a sole proprietor or an independent contractor. You're a member of a partnership, and that partnership is carrying on a trade or business, or you are otherwise in business for yourself, including a part-time business. So I'm not necessarily looking to rehash things that we talked about in 101, but at the same time, I think this is important to kind of tease out here. There's an example in the IRS publication that says that a guy who's in his garage, who's fixing radios on the weekend, just kind of super part-time, but does take a little bit of money for it, is self-employed. Now, he may only do, say, $50 or $100 a business, in a particular month, and he may only fix 1 or 2 radios or something. But the thing is, he's self-employed at that point, right? So it's a really broad definition of who is self-employed. But if you're self-employed, you're looking at self-employment tax implications. So where this really comes up the most often, I would say, is probably rehabs and raw land. Wholesaling is another one. But if you're a real estate agent, certainly it's going to come up. But let's just talk specifically about rehabs for a second. It's kind of odd because if you do enough deals as you're doing rehabs, you're actually considered a dealer in real estate. Basically, the real estate becomes your inventory, right? And where you cross the line into where the real estate becomes your inventory, you're considered this dealer of real estate, and you absolutely have self-employment tax exposure. So, if you're only doing maybe like one deal a year, and maybe it's your very first year or maybe even your second year, you might not not have crossed the line into this dealer in real estate kind of designation, you have to work with your tax preparer, your CPA, your attorney, to kind of figure out where that line is in your particular scenario. But I would say certainly if you're getting into 2 to 3 deals or 4 to 5, it's kind of that sliding scale, you're going to reach a point where you become this dealer and you need to think about self-employment tax.
And so let me ask you a specific example in here. So I'm just thinking, not sure why it's popped in my mind, but just, wholesalers. So I meet a ton of people, they want to get into wholesaling. And let's say brand new person, they do 1 or 2 wholesales where they, get a property under contract and then sell the contract and assign it to, Joe Schmo down the street. Would that categorize them as a dealer and trigger self-employment tax? Or is it one of those things, well, it depends on a lot of other factors?
Yeah, I mean, the only factor I think it really would depend on is how many deals they're doing, right? I would say, though, that the line of where that begins to look like inventory is probably much more compressed on wholesaling, only because it really, the contract itself or the contractual rights really is your inventory in that business. There's no other potential out of that other than just getting a property out of it.
Yeah.
Right. And then at that point, you're either looking at a rehab or a rental or whatever. And so really, I think that the line is much lower on that than, say, maybe 1 or 2 fix and flips, 1 or 2 rehabs. So it's a really good question, Chris. But I think, even at 1, I think you need to start thinking about self-employment tax. But I think we're going to maybe look at the whole year. How many deals did you do? Was it just the one-off, or, did you immediately follow up with another one? Or if there's 2, were they several months apart? Kind of similar factors to with the rehabs, but I think the line is a lot lower on it.
So I guess to boil it down to just kind of a simplistic viewpoint is, if you are, looking to make a significant income from one of these trades, and that's your intent, just plan on paying self-employment tax on there, unless you've used some of their advanced strategies to mitigate it.
Absolutely.
Okay.
Yeah. I think that's a good way to pull it back.
Because I don't know anyone that comes in, I just want to do 1 flip and I'm good. I just want to do 1 wholesale there. I just want to sell 1 piece of property as a broker. We all want to sell lots and do lots and buy lots.
Right.
People come in that with that low intention usually.
Right. Yeah. Let's not set the bar too high. Right.
Okay. Yeah. Well, that's so I just assume, like, whenever I do anything, I'm going to plan on paying a lot of taxes on it.
Right.
So this is good.
Yeah. Well, I'm glad you have that viewpoint. I think a lot of people are more surprised when they find out that they have to pay tax on certain deals that they do. But I mean, why does self-employment tax matter? I mean, why am I even talking about it or bringing up or coming up with strategies to kind of not get around it, but, the tax avoidance, right? Avoid paying more self-employment tax than I really need to. The reason that I bring it up is because there's Social Security and Medicare, FICA, FUTA, kind of this tax burden that falls on self-employed people that doesn't fall on employees, people who get the W-2 jobs, right? Basically, any of the associates in my firm, they are W-2 employees. And what happens is that as they're paid, they pay half of this FICA, FUTA, Social Security, Medicare tax. And then the employer, the firm, pays the other half, right? And so it's roughly 15.3% we're talking about here. But basically, the employer and the employee split that 15.3%, right? When you're your own employer, there's no law firm to pay that extra, whatever it is, 7-8%, right? And so you, as your own employer, you have to pay that extra tax burden. So when you're self-employed, basically, you're your own employer and you're paying the full 15.3% tax that you otherwise wouldn't need to pay.
And I just want to stress on, how much that can add up, because I talk to a lot of people that are getting into flipping or getting into wholesaling or just real estate in general. And I learned this lesson, 12, 13 years ago when I first became self-employed. A very basic example here, and I'm going to butcher these tax brackets, Peter, but federal tax bracket, let's say 25% now for, with the new tax laws that change.
Yeah, totally reasonable. Yeah.
We'll round up to 5% for Colorado just to keep it simple. So you're at 30%. Mm-hmm. So you make $100,000. Cool. I'm going to pay 30%. not too bad.
Right.
You add the self-employment tax on there, you go from 30 to about 45 and change.
Right.
You're at about almost a half a tax rate right there. So if I didn't screw you up and jump forward.
No,
Oh.
perfectly fine. Yeah. It's funny because that's almost exactly the example that I used here. Yeah.
I mean, great minds think alike.
That's absolutely. No, totally. Yeah. So I do want to jump ahead. Let's just talk about it. I mean, here with self-employment tax, what we're looking at, this example here doesn't take into account any of the avoidance strategies that I'm talking about here. And so, if you think, okay, about 15.3% in that self-employment tax, that's about $15,300 in tax on $100,000 of net income. I'm just keeping the numbers easy because I got to keep numbers easy to make my brain work after I leave the webinar. But, basically what I'm left with at that point is $84,700. Well, I use 35% just kind of as a general, okay, what you're going to pay after federal and state. That's probably a little high. 30% is probably even more realistic. But, when I take that out, I'm at about 49,700 net. And so if you look at that, really half of my money went to the government in some way or another, state, local, and also federal, right? And so total tax paid in this scenario, $50,300, that hurts. And when I give this talk in person, a lot of people actually kind of at this point say, man, that is really demotivating. And yeah, I agree, it is. So anything we can do to take the bite out of that is going to help. So yeah, anything else on that, Chris? I mean,
not specific to this, just kind of flashes back to like my second, probably third year when I was self-employed and actually starting to make some good money.
Yeah.
And just kind of tax planning. And yeah, I knew I had to pay the taxes, and I didn't know about prepaying quarterly taxes.
Ouch.
Then you talk about demotivating. I got my tax bill in the air, and I had to write close to $10,000 check, which was a ton of money back to me. It kind of drained my checking and savings account.
Yeah.
And that was demotivating. I was like, wow, ouch, that's a lesson to learn. And I got to make sure I properly pay and plan for taxes. So that just brought back some not so fond memories.
That's I'm glad that you're willing to share those kind of stories. I'm willing to share those kind of stories too. I'm pretty much an open book. But yeah, we go through these periods of life where it's just like, ouch, And
I take it as, hey, that's a good problem to have. I made some money, and it's just part of the education process. But hopefully this webinar and Peter's help can help you guys avoid some of those painful moments.
Yeah, absolutely. And that actually, I actually wonder, the IRS has a lot of penalties that they can levy, and they do. But the one that always gets me, and the one that I just always am like, oh, really? Is I think they have a failure to estimate properly penalty or something like that. I'm butchering the name of the actual penalty, but it's like if you fail to actually properly allocate how much your tax liability is going to be in the quarters, there's a special penalty that goes with that.
Really?
Yeah, and it's really tiny. It's like this really, really tiny penalty, but it's just kind of like twisting the knife.
Put some salt on the wound there, huh?
Exactly. Yeah. But anytime I see that levied, I'm just like, oh, really? Are we really going there? So, anyways, so self-employment tax, we're looking at about an extra 15.3% tax that you otherwise wouldn't have to pay on top of the, roughly whatever we said, 30, 35, maybe 25%, depending on where you are. But, depending on how much you're earning, Chris is exactly right. And it kind of scales with the amount that you're earning. I mean, that hurts. And that's especially if you're trying to launch your business or kind of get up off the ground, that's a pretty big tax burden to take on that really could go towards better things, right? And again, getting back to that idea of tax avoidance and just not making any extra gifts to the IRS, anything we can do to mitigate that is well worth looking at. So the planning strategy here that I'm going to recommend is to look at creating an S corporation. Now, Chris, it's funny, we've talked a little bit about S corporations in the past, and I know your barrier for when you might look at creating an S corporation, I think, is higher maybe than most. And so I want you to share your perspectives on S corporations as I'm going through this.
Yeah. And, I mean, want me to give you that number now?
Well, no, not necessarily.
Okay.
I mean, but more just as I'm talking, let me maybe lay this out a little bit. And then I want you to kind of give the counterbalance, and just say, but here's what I was thinking, or why, I was a little hesitant to set up S corporation, whatever, because it opens up, I think, a really good perspective. And we can talk more about that. But basically, with an S corporation, if you've ever heard of a flow through business entity, an S corporation is a flow through business entity. What that means is that the corporation itself is going to file a tax return, but it doesn't ever actually pay taxes, right? And so just to walk you through the kind of various things that I have on the slide here, what we have is net income going into the S corporation. And then the box down below that is saying, okay, there's no tax due at the corporate level, but it is going to file a tax return. It's going to file what's called a Form 1120S. It's the S corporation return, right? Then what the S corporation does is it pushes out the income to the shareholders, and then the shareholders are actually going to pay tax at their personal tax level, the 1040. So that's what that little star indicates there, right? Is that the shareholder themselves, they are paying the tax burden here and not the corporation itself. So the infographic here really is just saying, look, this is a flow through business entity, right? The corporation itself is not paying tax. And a lot of people get this confused with a C corporation. For instance, a C corporation has what they call a double tax problem because the C corporation pays tax and then the shareholders pay tax again. And we're not looking at that here. So really quick, characteristics of an S corporation: it's got great personal asset protection. It does put up a very strong corporate or LLC veil, and we'll talk more about kind of the differences there. But it does put up a really good veil between the person who's suing you and your personal assets. It avoids C corporation double taxation, which is a little bit what I was talking about there, where it is that flow through business entity, so only the shareholders are going to pay tax. It saves on self-employment tax, and I'll show you why that is coming up here. But because it is a flow through business entity, losses in the S corporation can actually offset other taxable income. So if you have, portfolio income coming in, another W-2 job, your spouse maybe works or something like that, losses in the corporation actually can go to offset the other taxable income earned by other taxpayers. So it's nice to have that flow through kind of taxation there. The reason that an S corporation saves money on self-employment tax is because of how you pay yourself. If you're active in the corporation, you actually pay yourself two different ways out of that corporation. The first way you pay yourself is a reasonable salary, and then the second way is a shareholder distribution. The reason this is important is because you pay self-employment tax on the reasonable salary, but you don't pay self-employment tax on the distribution. So just to put some numbers to this, let's say that you have, you own the S corporation 100%, right? You don't have any other person involved in there just because that makes it very easy. And then to keep the numbers easy, let's just say that I have $100,000 of net income. I'm looking to pay myself $100,000.
And so I just realized we've used the word net income a few times.
Yeah.
Some people may not know what that is. But
oh, sure.
You have your gross income, which is all the money you make.
Yep.
So let's say your revenue. So you have $200,000 in revenue, and $100,000 expenses. Your profits are $100,000, which is net income. Is that a good way to classify it?
Absolutely, yeah. And let's put it to an example too. I do 2 fix and flips in the year, sell each of them for $100,000, and that's before I take out my expenses. I've grossed $200,000, right? $100,000 on each deal. But to actually do the deals, I had to pay contractors, buy materials, clean, whatever else, pay closing fees, whatever else may be involved with that. And let's say that totaled $100,000 in expenses. Well, when I net out the expenses from my gross income, I get to net income of $100,000. 200
and that's what you
minus
pay taxes
100.
on, right?
Right, exactly. Yeah, you do pay taxes on that, and that's because your basis in the property went up, and when you sold it, then you netted 100, and basically the amount of your expenses just offset the revenue you otherwise would have. Yeah. Really important question there. That's good. I'm glad we went over that. But going back to this, so we have 100,000 of net income, right? So I've already done my deals and I've already kind of netted out my expenses and everything. Now I'm left with whatever's left over, so I'm going to pay it to myself. What I do is I pay myself a reasonable salary and I pay myself a shareholder distribution. So what I actually have to do is figure out what is a reasonable salary, which I actually do an entire webinar just on that topic. It's actually a little involved. So
Really?
yeah. So do talk to your tax preparation professional, your CPA, your attorney, whatever, to kind of hone in on what that reasonable salary actually is, and we can talk a little bit about it, Chris.
I would, and I don't know if you'll like this joke or not, but one of my other rules of thumb is when I see the word reasonable, I'm like, oh, that just digs up a can of worms for a lawyer, because people like to use the word reasonable, and then from my experience, they can debate the heck out of it, and there's no clear black and white right answer or wrong answer.
Yeah. A lot of people will send me a contract and say, well, can you just get your eyes on this, and sure, and then start reading it, and it's got all of this really wishy-washy language, and reasonable is a really great one. And I always highlight it, and I say, either that needs to be taken out, or we have to define what reasonable is, right? And a great way to do that would be like, okay, reasonable is like, what is the industry standard that a person would do if, whatever. But you do have to kind of dig down and decide really what is reasonable. And anywhere where there's that wiggle room, that's where the problems arise. And so the reason it's actually worth bringing up here is because the IRS is auditing what is a reasonable salary, right? The great thing is that we have a lot of tax court cases out there that actually set up kind of this rubric of what are you supposed to do to figure out what your reasonable salary is. And that's why it takes almost a whole webinar to really step through it, because I go over several court cases and whatever to kind of show you what the framework is. But at any rate, you pay yourself this reasonable salary. The thing is, because it's a salary, you actually have to partner with a payroll company, right? You actually do get a paycheck. You do get a W-2. You report it on your tax return as though you had a W-2 job. So line 1 of the 1040 or wherever the W-2 income shows up. And so because you have to work with a payroll company to do that, that's where the barrier to entry is, right? Because it's time, energy, hassle, and cost to deal with a payroll company to get that set up. Now, for most of my clients, depending on what they're doing, for most of my clients, they may cut only one paycheck a year, right?
Really?
Yeah, just kind of at the end of the year, whatever. Kind of look at how their performance has been, whatever, and there's ways to kind of make it scale, especially when we're talking about kind of husband and wife, smaller businesses, not businesses with 15, 16 employees, or even regular revenue, right? Because that's the other thing, is if we set you up for, say, every other week, well, you may not have a deal for several months, or whatever, and so it's difficult to actually make payroll when there's nothing coming in. So there's ways to kind of look at doing that, but that's where the barrier to entry is, right? So I guess, to kind of more concretely say exactly what I'm trying to say on this slide, it's like you have the net income. You're going to pay yourself two ways: reasonable salary, work with a payroll company for that, pay self-employment tax on that amount.
Because at that point, you're splitting the FICA, you're paying basically 7.5% as the employer,
yep,
and 7.5% as the employee.
Right. Yeah, so 15.3% on the reasonable salary, right? And then the shareholder distribution escapes that entirely. So let's put numbers to it, right? If you have net income of $100,000 and then you decide that a reasonable salary for yourself that year is $40,000, right? You're going to pay the 15.3% on the reasonable salary, the $40,000, but the $60,000 that's left over, that escapes the self-employment tax entirely. No 15.3% paid on that at all. Right.
So that would save you about $9,000 in taxes and self-employment then.
Right. Yeah, exactly. And I can, I don't know what payroll companies right now are charging, but I have a referral, or, what I tend to typically do is look for smaller payroll companies, not, the big guys, because typically what they'll do is they'll work with you, and the amount of tax savings oftentimes will outweigh the cost or the hassle, of dealing with a payroll company. But there is that tipping point, and you have to look at where that tipping point is, where it actually makes sense to do this, right? Because if you only do, just to stick with the idea of a rehab, a fix and flipper here, if you only do one deal and you don't net a lot of income on that deal, it's going to cost you more, or it's going to be more headache to run this S corporation than you're really going to get a benefit out of. But on the other hand, you could be a rehab, a fix and flipper who, they do one deal, but man, they really nail it out of the park, and if they do that, well, heck, then even just the one deal running through the S corporation can save you quite a bit.
Well, I can give you some numbers on payroll services because I've had
Sure.
3 or 4 different ones over the years. And I've actually had a free one. So what I did for years is Bank of America. If you have a business account with them, they've got a partnership program, I think, with like Intuit. And if you have, below a certain number of employees, I think it's like 2 or 3. So basically for the principals of the company, you get the free basic payroll service. And they will do all that stuff for you. However, you still have to go in there and file your state forms, which is a giant pain in the butt. I have done that. I'm like, oh yeah, whatever. I'm saving, $50 a month. And then guess what? An error comes up on a state form, and I spend 3 hours on the phone or on hold trying to figure it out. Talking to a person becomes a giant headache. So you can do it that way. And I've used ADP, and now I use from one of my old businesses, Bank of America's paid version, when they do everything. And they were both like about $40 to $50 a month. So I'd say about $50 a month. But with the S Corp, it's not just the payroll services. It's, the annual tax return. And that always seems to be, I've used different accounts. It seems like $800 a year for an annual tax return for an S Corp.
Right.
The filing fees, I don't know what they are in Colorado, if there are any.
$10.
Oh, wow. That cheap?
Yep.
Oh, wow. That's great. And then the annual meetings, which is just kind of a checklist, but I've had a hard time with that checklist over the years.
Yeah. I mean, let's talk about real concretely kind of your ongoing obligations. You pretty much nailed it. There's the 1120S, the tax return with the IRS. And I think your $800 figure is reasonable. That's roughly what we may charge at the firm. It kind of depends on a few things, but that's, I think, a good guidepost. $10 to the Colorado Secretary of State for your periodic report. And then you have the ongoing cost of payroll, which, there's a saying that kind of popped up recently for me, and I've been thinking a lot about it. I actually really like it. It's that the poor man winds up paying the most, right? Or the cheap man winds up paying the most. And the idea there is like, the free version may be really great, but you're going to pay a different way, right?
Like 5 hours on the phone.
Right, exactly. And so in my opinion, dealing with a payroll company who's going to kind of do it all for you is well worth it, because there's quarterly filings with the IRS. There's the Form 941s. There's an annual filing with the IRS called a 940. Those are employment tax returns. And then the Colorado Department of Labor and Employment, exactly like you say, they have quarterly filings as well, which can be more frequent if you're making more money or less frequent if you're making less money. So there's kind of some ongoing tax returns that happen during the year, generally quarterly. A good payroll company is going to take care of all that for you, right? And that's well worth it, because even myself, I have clients who get behind on those quarterly reports because either they were supposed to file them and they didn't, or they had a bad payroll company and they didn't do it. But at any rate, I always try to see if they can find a payroll company to do it for them, because frankly, the returns are not difficult and my hourly rate just prices me out. It's like, you don't want to pay me to do those, but oftentimes they wind up having to, because payroll companies get really nervous about filing past tax returns for some reason, because they think they're going to be on the hook for something or another. I don't really understand what their problem is, because I do it. I don't have a problem with it. But at any rate, there's headache that goes along with this, I think, is kind of the takeaway here, right? And so that's, I think, where getting good advice and talking to your advisors and maybe running some of these what if scenarios. I've talked a little bit about what if scenarios, but just sit down and look at it and just say, look, if I do 2 deals and I think I'm going to net this much, or I'm an agent and I think I'm going to do this kind of business this year and I think I'm going to net this much, run some scenarios and look at it and see how realistic your scenarios are, but then also see what the impact of an S corporation would be. Then talk to a payroll company and then figure out how much you're going to be out of pocket and what they really do, if they're full service, if they're not full service, whatever. But anybody, I can help, my firm can help you kind of navigate through this. But the idea is there comes a tipping point where, even though it's this headache, the amount of money that you're going to save, it's going to actually be worth going through that headache. But that also slides a little bit from client to client too, right? Because I have some clients who don't want to pay any more tax than they need to almost immediately, right? But I have other clients who say, well, worst case scenario, first year, maybe I wind up paying a little bit of extra tax or whatever, and I'll look at the S corporation next year.
That's my attitude.
Yeah.
I just like to keep it simple, because I just
Right.
did a quick calculation, going back to some you did out. So that $100,000, you put 40,000 through as a payroll to the employee, then you put 60,000 through as a shareholder distribution. The tax difference will say about $9,000 in FICA savings. Then the S corp expenses, what we just said, $800 for tax returns, $10 for the Colorado state filing fee, and $50 a month for like a payroll service, comes out to about $1,400 in expenses. So 9,000 minus 1,400 is what, 7,600?
Yeah.
What am I forgetting?
Somewhere around there. But if you are doing $50 per month for payroll services, that's assuming you're actually going to cut payroll each of those months.
Yeah.
Yeah. Because the person that I refer a lot of people to, by the way, it's Nanny Checks, Steve Gelman. I'll give him a quick shout out. Even though it's all kind of geared towards household help, he actually sat down with me. I explained what real estate investors kind of are all about and whatever. He's created kind of a thing for my clients that works for him, also works for my clients, it seems. But that's geared more at cutting like one paycheck a year.
Right? See, this is like new. I've never thought about that, or never been presented an option by that from previous professionals I've worked with. So
you'll still, well, a lot of people won't do it, and the reason is because they can't charge you the ongoing payroll fee, right? But if you're specialized around nannies or something like that, it may be a really similar situation, right? Where it's kind of pay as needed as opposed to that ongoing kind of thing. The problem with that is just speaking generally is, you still have to file the quarterly 941s and the annual 940. So you'll still have to pay the payroll company at least quarterly to file a zero return, right? And say, well, no wages were paid in this quarter, but you still have to file that return. And that's where people get screwed up and why I end up having to jump in and prepare these really simple returns, because for some reason that quarterly filing still falls under the radar or gets forgotten or whatever. So
we even using my, sounds like now probably higher estimates since we're doing monthly.
It's good to estimate high, I think. Yeah.
You're still coming out about $7,700 ahead in total, just pure numbers and stuff.
Right. And so, I mean, you can see though how that'd be a sliding scale because some clients are like $7,700. Holy cow, what could I do with that? And, whatever. Other clients are looking at it and saying, well, but, I was a little generous to myself in the number of deals that I might do or the income that I might net. And, let's get a couple of years under my belt and I'll kind of see, what it looks like. And for reference, creating an S corporation, you have 90 days after you create the company to make the election with the IRS to be an S corporation, then you're time barred, right? The IRS won't accept the election to be an S corporation after those 90 days. So in year one, where you set it up, you kind of have to make the decision, relatively early about whether you're going to be an S corporation. If you decide not to in year one, the window actually opens each calendar year again for roughly into like February. And so basically every single calendar year you can look at it. And so in 2018 here, or 2019, what year are we in? 2019 here, you can say, you know what, I'm going to play it conservative. I'm not going to be an S corporation. But if you nail it and knock it out of the park in 2019 and 2020 is looking very similar, in those early months of 2020, you can actually decide to be that S corporation and get that in place then later, right?
And then kind of like retroactivate it back to the first?
It would only be for that calendar year. So you're out of luck in 2019 if you decide to do it in 2020. No,
I mean, if I decide, I'm like, this is February 15th of 2020. Wow, my business is looking good again this year. I start it. Can I kind of say, keep it simple, go back to January 1st?
Yeah.
Okay.
Yeah, I think you can. There's a place on the form where you can select you list your effective date. And I think you just say, okay, 1/1/2020 is my effective date. So as long as it's before the deadline to get that paperwork in, I think the IRS wouldn't have a problem with that.
Great. All right. Well, I'm saving my number for what I think the tipping point is on the S corp until whatever magical slide we get to.
Yeah. Well, no, this would be the magical slide. I actually should have included the calculation on the other side of what an S corp would look like. But Chris, you did the math for me, so I appreciate it. And that's actually you're actually a little bit lower, but That's because you're taking the payroll and the tax return and those costs out. So 7,700, 7,500, somewhere around in there is probably the realistic number. Yeah.
When comparing this $100,000 net income scenario,
exactly.
Is what we're talking about.
The total tax paid would be reduced by about 7,700 or 7,500
net of the expenses of the S corp.
Exactly.
Yeah. So I don't know where I got this rule of thumb from. Because when I first got into running business and self-employed, I just read books, learn from other people, all that stuff. I don't know if it was a calculation I did or heard from someone, but it was, hey, if you're making about a $50,000 profit or $50,000 net income, that's when it's time to look at an S corp, and that's where the tipping point is worth the monetary expenses of an S corp plus just the time and mental space it takes to get it set up. And what are your thoughts on, hey, if I'm making $50,000 in profit, I should start looking?
Yeah, so here we are. We're generalizing, which always is great for me. I think it's funny because I have heard all kinds of different tipping points. 50,000 to me is actually not a bad tipping point. I was meeting with clients yesterday who actually talked to their CPA prior, and the CPA's tipping point was $100,000 of net income.
That seems very high to me.
I agree. I completely agree. And I think there's a misconception among a lot of professionals actually about how big the audit risk really is for the reasonable salary component and all of that. And I think when they think about payroll costs and those kind of things, they just they jack that number way high. I'm below your 50,000 figure. I'm actually at about 35,000, but that's because I almost as like there's an ethical rule as an attorney. You're supposed to zealously advocate for your clients, right? And so for me, it's kind of like, well, at 35 grand, I'm beginning to look, right? And say, well, does it actually make sense? But the thing is that you have to pay this reasonable salary, right? It's only an S corporation is only going to make sense if you're going to pay over and above the reasonable salary as a distribution, right? Because that's where the savings actually come. And so a reasonable salary is actually going to be different depending on what industry you're actually looking at. A reasonable salary, for instance, for an agent is going to be different than the reasonable salary for a flipper, which is going to be different from the reasonable salary for a wholesaler, right? And if you're actually combining some of those activities in the same S corporation, well, then that's going to be different, And so you kind of have to land on what that reasonable salary looks like and then say, well, okay, then how much am I taking out as a distribution then based on my projections? And then what am I looking at in terms of payroll costs and everything else? That's going to create where that tipping point is. And so, for me, like I say, about 35 grand, I begin to look, my ears prick up and say, well, this is maybe something we should be looking at. But ultimately, where that tipping point is going to be different for everybody.
So let me ask you something else here, because again, this just goes back to, I can't remember who told me this, where I learned it from, but I was always given a ratio for reasonable salary, not amount, but hey, whatever your profits are for the year, 60% salary,
right? And
you're chuckling over here, Peter, that people can't see. 60% for a reasonable salary and 40% for the distribution. So whether it's I make $20,000 that year, 60-40, or $80,000 a year, 60-40. Probably not the best way to do it, sounds like, based off of your your reactions over there.
My visible reaction, yeah. Well, no, it's actually very common. And it's probably the most common way that I see this done. And frankly, it's also probably the most common that I see is 50-50, right? That if you read the tax court cases, both the IRS and the tax court say that those percentages on their face are unreasonable. And the reason is because it's just random. And so I think there's a couple different ways to think about this. There's complete compliance, and complete compliance would be, well, what does the tax court say? What does the IRS say? And then how do I comply with that? Of course, wearing my attorney's hat and whatever, that's what I'm always going to advise my clients on, right? Because that's what they should be doing. But we can talk about alternatives, right? And there's always attorney-client confidentiality and things like that. And the idea is that you understand what the law is, and then you understand how to comply with it. But then we can talk about what you're really going to do, and you can decide the way that you want to move forward from there. And I'm not going to tell anybody what we talked about or how we came to the decision that we came to, right?
Okay.
So at any rate, the reason that I bring that up is because there's complete compliance, which is what does the tax court say? Then there's let's talk about audit risk, right? On small amounts, if you go with the 50-50 split, let's say that you net $10,000 for the whole year. Yeah. If you go with a 50-50 split, you're paying yourself a salary of $5,000.
So $500 a month does not seem very reasonable.
Right. So probably that whole 10 grand, 100% probably needs to go to your salary. Do you see what I mean?
Yes.
But on the other hand, if you make $1 million, 50-50, you're paying your salary of $500,000. That's probably way too high, right? Like also not reasonable. But then again, the IRS is probably never going to audit that return because you're paying a boatload in self-employment tax.
So they're happy.
Right? Exactly. Yeah. And so that's not really like an audit trigger or an audit red flag or something like that. Right. And so you can kind of think about it that way as well. But what the tax court actually would have you do, and this is very difficult to do, but basically there were a couple different approaches that were proposed through the court cases. One was percentages and saying, well, 60-40 or 50-50 or, whatever it may be. Tax court said on its face, that's not reasonable. So then the IRS came along and the IRS said, okay, we're going to figure out a formula. And the formula is figure out an hourly rate that more or less kind of makes sense. And then, okay, how many days in the year are you working? And, how many working days are there total? Let's take weekends out of that. Are you working part-time? Those kind of things. And they created an actual formula to come up with what the reasonable salary should be based on an hourly figure. The first time that went up to the tax court loved it. The second time and every subsequent time it went up to the tax court hated it and said that it wasn't reasonable. Right. And so what the tax court finally landed on is kind of this idea where you have to look at a similar company in a similar geographic area doing the same work. And then you're supposed to look at a person in that company doing similar work to yourself. So, for instance, are you the janitor or the CEO? Right. And what does the salary figure for somebody doing a similar job in a similar company? What does that look like? Right. That's your starting point. Then you begin to customize it and you say, well, yeah, that's fine. That's my starting point, but I work part-time. So I'm going to cut that figure way down. Right. Or, my company did more relative deals than that other company. It's way more successful. So maybe I need to pull my salary figure a little bit higher, or that other company's way more successful than I'll ever be. I'm pulling my salary figure lower. Right. So you kind of start with like, what is reasonable in the area that you're working, and then try to customize it based on your own circumstances. And you're supposed to keep paperwork, by the way, of how you landed on that figure, because then the IRS can look at it.
The S Corp owner and their team are supposed to keep a record on that.
Great formality for your LLC right there. Have a meeting, could draft up some minutes, and have a little salary negotiation.
Yeah, that sounds like one I might need a couple beers over to deal with that brain damage.
Invite your attorney.
So let me ask you this, because I'm really curious now. I know because I love this word reasonable with lawyers. So you mentioned there's different reasonable salaries for flippers, real estate agents, and wholesalers. And again, I think it's very hard to compare. Again, that's not usually public data, and most flippers, wholesalers, or realtors are one-man shows or husband-wife teams or small partnerships.
Right.
So I don't see a public way of finding out, but can you give us just a rough estimate without going through the webinar? No,
I can't. And the reason is because it's driven by so many outside factors.
Okay.
This is actually incredibly difficult to do. And it's not often that the tax court, I think, will not give you kind of a bright line rule and just say, this is how you're supposed to do this. Instead, they gave us this framework, and it's really difficult to go through this framework. The best that I can say is land on what you think your reasonable salary is and document it. And I think if you document it and explain why you think your reasonable salary is what it is, that will go further in terms of kind of defense and whatever on audit than anything else that the IRS can possibly argue as a counter. I assisted a gentleman going through an audit and they were auditing this very issue. And I advised him exactly the way that I just advised right there. And he produced his meeting minutes that showed exactly why he landed at his reasonable salary. The IRS agent, on the other hand, didn't know enough about the law and just basically said, I'm going to give you a 50-50 split. And I said, awesome, do that. Right. Like I encourage, kind of not like in a mean way, but more just like, okay, yeah, go ahead and do that. Right. And then I requested a meeting with his manager. I plopped down the 5 or 6 court cases that I had that showed what my framework was. And I said, what's reasonable here? Right. And that problem went away. So, this is an area you don't have a bright line rule, but on the other hand, it's reasonable is squishy, for lack of better. That's the technical legal term, right? Chris, is squishy, but it is squishy, and that actually works in your favor as much as it can work against you. Right? Okay. Yeah.
So I'm reading your next slide here. You have gaming the system, and I started down this path one day until I was brought back to the correct way, which is where I was that year. It was a tight couple months turned into tight years. It was back when the world was falling apart.
Sure.
And so I didn't think it's sorry. I'll just distribution next month, distribution next month, distribution. And then my account was like, "What the hell are you doing?" I was like, "Distributions." He's like, "No." So that is apparently not allowed to do, I learned.
Yeah, well, no, Chris, you were not alone in that. When everything just completely got turned upside down, we saw a lot of things out of there. And there's a saying in the world of law, which is like bad facts make for bad case law. And that's exactly what happened, actually, is a lot of this reasonable salary case law that we're pointing to now, 11 years later, or whenever, after everything did get turned on its head, points back to that time, because there were a lot of people just trying to make it by. And when the IRS then audited, there were a lot of bad facts there, right? And so then the judges and the court system's like, well, God, how do we even deal with this? And so then we have a lot of really kind of like weird law coming out of that, addressing these really nasty facts. And so no, you're certainly not alone there. But the reason I bring this up, and I totally overcooked it, by the way, with all this Al Capone stuff. Like I don't think anybody's going to jail over this, right? But my point is that there's a natural tendency here to try to game the system, right? And I said that the tax court really doesn't give us bright lines in this area, but that's not exactly true, because there are some bright lines, which is like, okay, you taking $200,000 in distributions and no salary, that on its face is going to be unreasonable, right? Or taking, even I've seen facts, and it always involves doctors and lawyers because they're always the ones pushing the envelope. But if they're paying themselves a $10,000 or $20,000 salary and $100,000 in distributions, that on its face also is unreasonable. So you need to be going through that process that I'm talking about, right? Documenting why you think what you're doing is reasonable. But the natural kind of tendency here is to pay yourself huge amounts of distributions and take $0 in salary, because that's going to save you the most in tax. But I can tell you that's going to get you audited, right? And so that gets us back to tax avoidance and tax evasion, right? You want to avoid tax. You're going to set a reasonable salary and not pay self-employment tax on anything over that reasonable salary. But don't game the system too much, right? Yeah.
Makes sense to me.
Yeah.
I like your Monopoly get out of jail free card. I just noticed that on there.
Right. Yeah. So, that's maybe enough on that. We've burnt actually a lot of time on self-employment tax, which is good. But, a really quick word about the LLC. I've been talking about S corporations exclusively this entire time, but a really cool thought experiment, at least I think it's cool in this weird, tax attorney kind of nerdy way. But if you ever want a thought experiment, drive down the street and notice what business form all of the companies on their signs have taken. INC indicating corporation, LP indicating limited partnership, LLC indicating limited liability company. If you actually do this thought experiment, you'll find that probably 90% of the companies out there all are LLCs. And the reason is because of this slide here. The LLCs are great for asset protection. They really have all of the benefits of corporations when it comes to the LLC or the corporate veil. But the LLC is incredibly flexible for taxation purposes. If it's single member, it can be a disregarded entity. If it's multi-member, it can be a partnership, or it can be either type of corporation. It can be an S corporation or a C corporation. So when I'm talking about S corporations, through this thing, we very easily could actually substitute the idea that it's going to be an LLC taxed as an S corporation and not just an S corporation itself. So, okay, so let's move on to our next topic. Kind of up to you, but yeah. So real estate professional status, basically with this, and we talked a little bit about this in 101. Basically, real estate income is per se passive income, right? The idea is that you're not necessarily, at least the IRS views it this way, not necessarily very active in your rentals. Although, tell that to my clients who have 12 rentals and are self-managing and whatever. But the idea is that it's this passive income, right? And so there's special passive income rules that are going to apply. So I have my buckets back up here if you saw 101. But the idea is that you have net income from real estate, and that's going to flow into and be separated into these two different buckets. You have normal income, and normal income is just W-2 wage income, 1099 income, capital gains, investments, dividends. That's kind of your normal income bucket. Passive income bucket is going to be rental income or income from activities in which you do not materially participate. But mostly here, we're going to focus on rental income, right? So we have the two buckets. What's the point? The point is that your passive losses, so losses coming off of those passive activities like rentals, are not going to offset your normal income. So if I have rentals and I have passive losses coming off of those rentals, it's not going to offset the income that I earn as an attorney, right? And so if I add losses or more to this picture, this is what I come up with, right? You have the two buckets for your income. You have normal income and passive income. But if you have any losses, which is kind of down there on the bottom of the slide, losses from your activities are also going to be split into two buckets. You have passive losses and you have normal losses. Normal losses offset normal income. Passive losses offset passive income. But the point is that your passive losses actually cannot go across the field there and offset your normal income, right? That's the general rule. Real estate professional status is just a way to short circuit that and actually get it so your passive losses can offset normal income, right? So if you don't really have losses, right, and ideally you don't, the idea would be that you're actually making money. What we want to do is we want you to talk to me or talk to a tax professional and look for planning opportunities. What we're going to generally do is look for really large paper deductions that are going to actually show a loss on your tax return while you're still cash flowing. So the greatest example I have there is depreciation, right? Just over time, you're recovering the cost that you paid for a property, and that's actually going to wipe out some of your income.
Which is an amazing tax benefit of buying properties.
It is, absolutely. And I was trying to explain this to my wife the other day about, just how people can actually make money, but actually show like zero income on their tax return. It's a really phenomenal thing. But what happens if you have more passive losses than your passive income? Well, I kind of already mentioned it, right? Your passive losses are going to offset your passive income, but if you have more losses than your income, what you're going to do is you're going to carry it forward to the next year because it can't offset other income that you typically have. And so your passive income is going to, if you have passive income in a later year, that can eat up your loss. But otherwise, what you're going to do is you're going to take those passive losses when you sell the property is really what it comes down to, right? And so it would be really great to accelerate that, right? To actually recognize these passive losses as soon as possible. So that way you're not showing as much taxable income and not paying as much tax to the IRS. So real estate professional is the way to do that, right? It's actually an election that you take on your tax return. On the very last page of the tax return, it's an election. It's in a statement. It says, this taxpayer elects to be treated as a real estate professional under, the particular code section, and you're on from there.
So it's just like a checkbox on the form?
More or less, yeah.
Okay.
Less of a checkbox checkbox than it is like an actual blank sheet of paper on the back of the tax return with a sentence written, that actually says that you're electing to be. But if you're working with a tax preparer, our software just automatically generates it. So for me, it's a checkbox. For you guys, it's not. But anyways, to be a real estate professional, you have to meet two tests. The first is that you have to spend more hours on real estate activities in which you materially participate than non-real estate activities. And the reason I've underlined these things here is because we're going to pick this apart a little bit more. But anyways, the first test here, you must spend more hours on real estate activities in which you materially participate than non-real estate activities. And then the second, you have to spend more than 750 hours providing services during the tax year in real property trades or businesses in which you materially participate, right? Now, that's pretty much taken exactly from the tax code. And so you can see why it takes almost a degree to even pick apart the tax code. But at any rate, we'll pick this apart a little bit and see exactly what this means. So the first place to start is I'm actually going to start with real property trades or businesses, okay? This is actually very widely construed, and the tax court is generally very taxpayer friendly here in terms of what actually constitutes a real property trade or business. So just kind of going through examples that I've seen in case law and everything else, we're talking about real estate development, redevelopment, construction, reconstruction, acquisition, conversion, rentals, operations, management, leasing, brokerage income. We're really talking about a wide variety of potential activities that are going to fall under that umbrella of real property trades or businesses. Material participation, you have to actually put a certain amount of sweat equity into your activity to actually make it not passive, right? That's more or less what we're trying to show here. And so the first one's pretty easy. You just participate in the activity for more than 750 hours. That's one way to show material participation. Another way to show
these are like ors.
It's all ors, yeah. And it could be ands in some cases, because like 1 and 2 might actually work together. So you participate for more than 750 hours, but your participation is also substantially all of the participation by all individuals. Like nobody else helped you with the property, right? But it could be an or, right? If you don't get up to that 750 hours, you're less than that, but you're the only person working on the property, you still meet test 2 there, right? Third, you participate for more than 100 hours during the tax year, and that activity is not less than any other individual. So that's kind of setting the floor there, 100 hours, and nobody else puts in more time than you. We can kind of ignore the other ones down there, except for number 7, which is facts and circumstances. It's like under all the facts and circumstances, your participation was regular, continuous, and substantial. Well, that seems really taxpayer friendly, right? A lot of people are going to argue that their activity was regular, continuous, and substantial. I have used that in tax court. I have used that against the IRS, and I get laughed out of the IRS offices every single time. And so you can't really rely on number 7 just by itself. You need to kind of pair it with numbers 1 through 3 up there.
Okay.
Yeah. So anyways, now that I've defined that a little bit, let's go back and look at what the tests are. You have to spend more hours on real estate activities in which you materially participate than non-real estate activities. What that's really saying is more than half your time is put into real estate activities, right? And you have to materially participate in those. So think 750 hours, or you're the one really doing all the work, or it's more than 100 hours and nobody else puts in more time than you, right? Then you have to spend more than 750 hours providing services during the tax year in real property trades or businesses, which again is really broadly defined there, right? And then you have to materially participate in those real property trades or businesses. So have I thoroughly lost anybody, or you, Chris, or is this making sense?
It makes sense from a high level overview. I do have memories of like spending a long time on Google trying to understand this stuff years ago.
Yeah.
But I think the punchline is that hey, if you have this real estate professional designation, you can offset some W-2 active income with your passive losses.
Exactly.
It's kind of like the big thing to keep in mind. And then if there's any chance you are a real estate professional, figure out the rules, talk to your tax professional, right?
Yes. Yeah. And I think the biggest thing here is I will never be a real estate professional. And the reason is because I'm an attorney, right? And more than half my time is spent just being an attorney. I mean, the time I spend on emails with clients alone is going to far exceed anything else that I could do in the day. I tend to think of myself as very productive, but I'm not Superman. I'm not going to go home and put in even more time in real estate. It's just not possible for me. But on the other hand, if you are a real estate agent, or you have a lot of rentals, or you're doing rentals and fix and flips, and that's really all you're doing, this is probably something you should be looking at, because you don't have something else that's taking up all of your time, right? And 750 hours sounds like a pretty large, maybe to some of us, sounds like a pretty large barrier to get over. But actually, if you do the math, it's not even a full working week. It's not 40 hours a week. It's less than that. So if you're spending more than half your time in real estate, chances are you're probably already meeting these tests, right?
I just did 750 divided by 52 weeks, and it's 14.4 hours a week.
Right. So some people would say they could do that in their sleep, and maybe some people do. But, so it's a great segue into takeaway breakdown. I mean, how to be a real estate professional. I like to think about it as 3 flaming hoops, even though we've only talked about 2 requirements. And it's just kind of the way that you pick apart the statutes. So if you participate in a real property trade or business, let's jump through flaming hoop number 1. Spend more than half your time pursuing real property trades or businesses, right? Should be easy for a lot of listeners on this podcast, not easy for me, right? Jump through flaming hoop number 2. You have to spend more than 750 hours in the year pursuing a real property trade or business. And then if you have a property or activity that's going to generate a loss, jump through flaming hoop number 3. Ensure that you materially participate in the activity under one of those 7 tests that we looked at, right? And if you do that, you're going to save a lot of money on taxes, because what you're going to do is those paper losses that you're generating through depreciation or other tax strategies is actually then going to offset other income that you may have from other sources, right? And a really great example of how this might work would be if you are involved in real estate, but your spouse is working a W-2 job. Generate paper losses and offset your spouse's active income, because that's going to save you a boatload in taxes.
Because that was just going to be my question, because that's kind of my situation where I'm a real estate professional status since I'm a broker. And let's say wherever my net income is 50,000, I have $100,000 in paper losses. And then, so great, that wipes out $50,000 in my income as a real estate professional. I got $50,000 left over.
Right.
So if I'm not a real estate professional, that $50,000 will basically sit there and get used up over the upcoming years.
Right. And ultimately when you sell the property.
And we're going to sell the property. But since I'm a real estate professional, that $50,000 could go over to my wife's income and then reduce the taxes that she owes.
Exactly.
But that would only reduce federal and state, not FICA, right? Because she's already getting W-2.
Yeah, Chris, I'm laughing here because now I'm really racking my gray cells. I think you're right. Yeah, I think that is right.
Okay.
Yeah.
Okay.
Yeah.
But the bottom line is, you can see if I can take an extra $50,000 in losses this year against my wife's income, who's a veterinarian, so nothing to do with real estate, and she has no interest in it. I mean, that would save us, taxes on $50,000, which is a lot of money.
It's not insignificant. Yeah. And so, I mean, I keep mentioning these paper losses, and, so how do we do that? Depreciation is a huge tool to do this. And so the question is, well, how do we maximize depreciation, right? How do we try to take as much depreciation as possible to generate those paper losses? And the great thing about paper losses, I'm kind of throwing this term around, but the idea is that you're still cash flowing, right? I mean, you're still actually netting income off of these rentals, but when everything hits your tax return, you're showing a loss, right? And so you're not actually generating any kind of tax liability with that, or a reduced tax liability associated with the cash flow, right? So anyways, how do you maximize depreciation? Well, there's this great tool called cost segregation. So, Chris, I'm going to put you on the spot here and say, do you know what the depreciation recovery period for non-residential real property is? Commercial property, basically?
39 years?
39 and a half years.
39 and a half.
Nice. Yep. Do you know what the depreciation recovery period is for residential property?
That I do. 27.5.
27.5. These are really long recovery periods. Those are brutal, right? Because if you purchase a property for, say, $300,000, it's residential real property, you're going to recover the cost of that over, incrementally over 27 and a half years. That's going to take forever, right? Well, cost segregation is a way to actually speed this up. And that's really the whole point of what we're trying to do here. So what is it? Cost segregation is basically just looking at the individual components of the property and actually listing out the different recovery periods for it. So, for instance, when you purchase a property, you're not just purchasing the property, right? You're purchasing the carpet in the property. You're purchasing the wiring in the walls. You're purchasing the light fixtures. You're purchasing, right, all of these individual components of the property. Well, if you have a professional come in and actually look at all of these different components and say, out of the purchase price that you paid, this much of the purchase price went towards the carpet, this much of the purchase price went towards the wiring, all of that, then what you can do is speed it up, because carpet depreciates over a much faster period than 27 and a half years, right? If you look at the depreciation recovery periods, for instance, there's 5 years, 7 years, 15 years. It kind of depends on what you're looking at. But if we can recover cost over a 5-year period versus a 27 and a half year period, that's going to benefit you, right? You're going to front load your depreciation deductions, and that is going to wipe out more income. So if you're actually then generating larger depreciation deductions because of the cost segregation study, real estate professional now all of a sudden might get really relevant, because you might be front loading really large depreciation deductions in year 1, year 2, year 3, and all of a sudden you can wipe out a lot of other income because you're showing bigger losses, right? So, these are really rough examples. I didn't even really apply certain recovery periods and things. But if you buy a $500,000 warehouse, for instance, now that's commercial property, but you have to depreciate that over 39 years, the full $500,000. Well, if we can split up that $500,000 over that 39 recovery, instead of using that 39 recovery period, if we can apply some of that purchase price to 15-year property, 5-year property, and find a way to deduct $100,000 immediately, that's going to be a much better scenario for you.
So before you jump on, I want to ask you a question on here. Maybe get some free tax advice from you here. Yeah. So I'm under contract right now for a fourplex, $850,000, and these are some rough numbers I'm running. I'm actually kind of trying to figure out if I want to do cost segregation. So the building base is about $722,000.
Okay.
Just I'm using tax stuff, so real rough numbers here.
Yeah. So land represents the difference there.
Yeah. So 850 is the difference of like 120 something's about land.
Yeah. And listeners, that's important because the land is not depreciable at all. And so we have to take out the cost of the land from what the building actually costs, because the full purchase price is not 100% your building. It's also going to be somewhat to land.
Yeah, great point. And so, 722,000 divided by 27.5 years is about $26,000 a year in depreciation, paper losses. So, I mean, that's still a good chunk of money. And I went to a website a while ago, and they kind of do a quick cost segregation estimate, and they estimate about $150,000 I could front load it and all this stuff. And then then my following years will be less. But my thought is, or I don't know if it's even allowed or what it is, but hey, do the cost segregation, get that $150,000 front loaded, which will, wipe out any profits from that property that year. Then let's assume it, kind of wipes out my income as a real estate professional, and then some's left over to go, wipe out some of my wife's income. And hey, that should be a very big tax return back for us this year. I've estimated kind of like $20,000 to $30,000 potentially. I was like, well, hey, that's almost, that's a good chunk for a down payment on the future property. So I can kind of front load the depreciation, get some cash back, and accelerate buying another property and just kind of repeat like that. Is that something that's people do, or am I kind of this is all conceptual right here? Conceptual off basis.
No, conceptually completely on basis.
Okay.
I think that's a really reasonable way to look at this, and I think the way that you're stepping through everything and showing the impact of real estate professional is great, because I think that maybe puts it more concretely for everybody on the podcast too. But I guess the you can see, so conceptually totally on point, and I love it. You can see, though, two things coming out of that, which is, first off, you're getting a really large refund, right? So you can see maybe an audit flag there, right?
Okay.
Because and you can see what a powerful election real estate professional is, right? And so maybe an audit flag there. And that actually gets us into record keeping, right? And I didn't talk really about record keeping at all. But you need to be keeping a log. And your log needs to kind of keep track of, okay, how many hours am I putting into this activity, and whatever. And the idea there is that the IRS, if they do audit, we can go back and we can look at your time and say it's no problem showing the 750-hour requirement or not, right? But that's the thing, is that is such a powerful election, that you're generating such a large refund, that under the right circumstances, the IRS actually could say, hey, let's go take a look at that.
Let's roll our sleeves and dig into your returns.
Right. Yeah, a little bit. Let's just make sure.
Because even though that might not be an issue, they'll turn up poor record keeping or other things like that potentially.
Yeah, I mean, I've litigated a lot of real estate professional cases, and I can give you kind of two really good outliers. One was okay, to show you how bad the bad was, maybe I'll start by showing you how good the good was. The good was 2 bankers boxes filled with receipts that tied to the dates in the logbook, right? That showed exactly where the guy was, what he was doing, the expenses incurred, whatever. But if he ever went out and visited a property or something like that, he printed off the sheet from Trulia or Zillow or whatever, showing where he went and why he was there, who he met with, the reason he was there, or whatever, And so he had 2 bankers boxes filled with documentation showing everything that he did and where he was and the time that he spent doing it and everything. Now, that's a lawyer's, I slept really well that night.
That's like your dream, right?
Exactly. I'm like, oh my God, this is going to be the easiest case ever, And part of this also was probably my inexperience at the time. And again, this is me being an open book, but part of this probably was my inexperience at the time. But what I did was I actually went into the IRS office and just slapped down the 2 boxes on the conference room table and just said, where do you want to start? Right. I mean, at this stage, I'd probably be a little more organized and a little more measured in how I do it.
Maybe not so cocky.
Yeah, but I mean, but at the time, it pretty much was that, and the IRS looked at it, and we did go through things and whatever, but at the same time, it was kind of I don't want to deal with that, and that case went really well. The other case, on the other hand, was just a logbook, no underlying documentation whatsoever, and then the other guy, I should talk about his logbook. It actually had start and stop times, right? And so it was 8:16 in the morning to 10:35 in the morning did this, right? Whatever. And so, yeah, he's an outlier, I know. But the other guy was basically wrote 2 emails and wrote down an hour, right? And an hour for 2 emails is a little questionable, right? But aside from that, the 1 hour in the column was in a different color ink and also looked like newer ink, right? And so, okay, I only have a logbook. It has these really large estimates of time, and it looks like it's not a contemporaneous kind of accounting of time. That case did not go well. Right. Yeah. And so, the record keeping is kind of a whole nother discussion, but you do need to be keeping records because it is a really powerful election. You can generate really large refunds and benefits to yourself. And so the IRS, under the right circumstances, could come look. But the other thing that comes up from your example, Chris, is depreciation recapture. You're front loading these depreciation deductions. If you dispose of the property, you've taken more depreciation than you might otherwise be entitled to, right? And so you could actually generate some recapture to yourself, which in that case, just for everybody to know, you basically have to pay back the benefit of the accelerated depreciation that you took, right?
Yeah.
So if you go and you take the proceeds and you roll it into another property, and now it's tied up in another property, and you generate a tax bill for yourself because you sell another property and suddenly there's tax implications there, you're going to have to come up with that money from some other source, right?
Can I ask you, because this is so interesting, actually got into a very, I don't know how this came up, but a very long email thread between me and some other investors, realtors, none of us are tax professionals, talking about this very thing.
Yeah.
So I'm probably jumping to tax 301 here, but I think most listeners are familiar with the basics of 1031 exchange. So if I do the cost segregation, front load it.
Yeah.
Now, if I sell the property, I'm going to pay recapture depreciation.
Yeah.
Now, if in 10 years I 1031 it, am I paying capture or does it get rolled down the hill? And you're laughing, you're hating me right now.
I'm laughing because holy crap, is that a good question?
And probably no one's listening right now to our recording anymore because everyone's in a rabbit hole. But I am thoroughly enjoying this.
Yeah. Wow. Chris, I actually don't know the answer to that
Okay.
offhand. My sense is, though, there's two possible ways it's going to get treated. Either it's going to go into your basis, and so you're kicking the can down the line until you sell the property that you 1031'd into, right? But in a way that almost feels like the incorrect result from the standpoint of the IRS, because what you're doing is you're kicking that recapture obligation however many years into the future. And actually, the ultimate strategy with the 1031 is to die.
Yeah, I mean, that's my plan. 1031 till I die.
Right. And then you get your heirs get the stepped up in basis, no taxes ever paid. And so that recapture actually is never paid. Right. Yeah. If you take that ultimate kind of approach to it. So that to me kind of feels like the wrong answer, but it is a possible answer. The other answer would be that you treat it like boot. And so just so you know, like if you 1031 and there's cash that comes out to you, you have to basically pick that up as ordinary income and you pay tax on that. And I kind of wonder if maybe the recapture isn't treated as boot.
Oh, really?
It's possible.
So when it comes to, if I take the depreciation, the accelerated cost segregation depreciation this year, 1031, 10 years, I may. So, okay. I'll talk to you more about this when we're offline because this is actually something I'm considering.
No,
I'm trying to figure it out.
Yeah, it's really interesting. Yeah.
Right.
All right.
Sorry, everyone, but thank you for listening.
Okay, yeah. So anyways, the last thing I want to talk about here is just more driven. It's driven less at depreciation, driven more at, it actually is depreciation also, bonus depreciation. But what it's looking to do here is actually to generate larger deductions for you in the current year. Bonus depreciation. So we used to be able to take advantage of it. It used to be 50% of new equipment, but is as part of the Tax Cuts and Jobs Act, it's actually now increased to 100%. So under the right circumstances, we can actually immediately depreciate something 100%. And that seems kind of weird because depreciation doesn't typically happen in 1 year, but that's more or less what we're talking about here. It phases out in 1/1/2023, so we do have to take advantage of it here in the next couple of years. But what is the newest part of this is that actually used property now qualifies for this bonus depreciation so long as it is new to you, whereas in the past it actually needed to be like a new piece of equipment rolling off the line, right? So you can buy a used piece of property now and it still qualifies for bonus depreciation so long as it's new to you. So that's really all I'm going to talk about bonus depreciation. There's also Section 179 expensing. 179 basically is like just immediately expensing the full amount of a piece of equipment or something like that. It's very similar to bonus depreciation in a way. But basically 179 is really great for improvements. And when I say improvements, we're talking about roofs, heating, ventilation, HVAC, right? Fire protection, security systems. Basically anything that doesn't enlarge the building, is not elevators and escalators, or maybe the internal structural framework. That's not going to qualify for Section 179, but anything else really is. And so 179, the line between 179 expensing and bonus depreciation is sometimes very hard to draw because they seem very similar and they're tools that can be kind of used for the same purposes. But what I would do is make sure that your tax preparer is looking at both Section 179 and also the bonus depreciation to see if maybe there's a way to actually take the full amount of your expense this year rather than trying to get it over several years. And then the other difference between Section 179 and bonus depreciation is that Section 179 can't result in a loss, whereas bonus depreciation can. And so the only time we're going to look at using Section 179 is if you have enough income to actually wipe out or enough income that we can actually use Section 179 to wipe out the full cost of the equipment without actually resulting in a loss.
So it sounds like I might convert or try and put this in some real estate investing work. So you have, for Section 179, things like roofs, heating, ventilation, air conditioning, fire protection systems, security systems. Those are typically classified, or we categorize them as like capital expenditures, which you can't write off, have to be depreciated. So I guess we could say this would work for capital expenditures, where you could possibly write off the full thing this year then?
Yeah, I like that.
Okay.
Yeah, I like that explanation. Yep.
Ah, so cool. Okay.
Yeah. And so what this is going to do once again is help you, rather than recovering something over a recovery period, maybe 5, 10, 15 years, we're just this year saying, well, what did your new air conditioning system cost you? All right, we're going to just take an immediate deduction for that amount, right? Rather than, writing it off whatever it would be over 7 years, right? Yeah, so just a way once again to kind of generate really large paper losses if we can. And if we compare that with real estate professional status, now we're really cooking with gas, right? So just a quick recap here. We talked about self-employment taxes. S corporations is going to be a great way to address that. Again, everybody's tipping point. And we talked a lot about where that tipping point is. Everybody's tipping point is going to be slightly different on when it makes sense to do that, but it is a really good strategy to look at. Real estate professional status. We're just going to try to recognize passive losses as quickly as we can rather than carrying them forward year after year after year and then maybe waiting until you sell the property to actually take those losses. Cost segregation. We're going to look at doing a study to split up the cost of the acquisition of a property and then try to recover those amounts as quickly as we can. And then Section 179 expensing and bonus depreciation. Again, just trying to wipe out as much income as we can and speed up the time frame where you're actually recognizing certain deductions. So
now for cost segregation, is that the study? Is that something that your office does? Do you outsource it? Or I know there's like softwares now that kind of like a DIY for usually a lot, much less expensive than sending an engineer out to the property to do all that stuff. What options do, if I come to you, say, hey, help me with this fourplex, cost seg it, just what's the quick rundown what that looks like in a real rough expense and time frame?
Good question. I mean, we as an office don't actually do it.
Okay.
And the reason is because, you need a certain level of expertise, I think, to get there. To when I say get there, to actually see what the property looks like, to actually split it all up, and then there's actually a form with the IRS that you have to fill out and submit, and there's really specific time frames. I can't even share it with you because it's really complicated actually how it works, but it's a form 3115, which is basically you're changing your accounting and requesting permission to do that, and anyways, the 3115s are actually very technical, and the people that we typically refer our clients to take care of that 3115 for you. And so not only do they come to a really good kind of allocation of cost over the different pieces, but then they also generate this really complicated IRS form for you. So that's really nice, and we found that works really well.
So that's just like a partner or vendor you work with?
Yeah, I'd have to get their referral information offhand. I can't even remember who it is, but at any rate, we do send quite a few clients over their direction. And then I've run into some of the softwares. It's going to depend on which software you use. I would make sure that it does generate this 3115 because that's terribly important. But I will say that our tax preparers in our office have seen varying degrees of quality when it comes to those software programs. And so I would vet it. I would talk to other people, and particularly now that we're through tax season, more people may have some more experience with it and kind of their experiences using it. But I'm not steering you away from the software platforms necessarily, but I know coming out of tax season, those who had used the software, we were going to maybe provide referral information to an actual firm that does it, just to make sure that it was done correctly.
So like non-software ones?
Right. Okay. Just to kind of get another set of eyes on it, because some of them were a real mess. So
good to know.
Yeah.
Peter, thank you.
Yeah.
Oh, was that your last?
No, I think that's it. I think I'm done. Yeah.
Yeah. So, I really enjoy this, and wonderful data. How can people get a hold of you if they need help tax planning? Just reach out to you at the
info
Business Innovation Group.
Yeah, info at bigprofitsolutions.com, our website there, bigprofitsolutions.com. Also, you can give us a call, 720-922-1120.
Awesome. Peter, thank you so much. I really appreciate your time.
Yeah, thanks, Chris. So obviously